Tesla's stock is down about 3.5% today, and the reason for this is surprising. Some would say an outright lie, maybe. We're going to go ahead and get into it here in this video. We're going to break down all of the major news you need to know and what's happening out there in the markets. Oil is up over 3.5% today. The treasury market is collapsing, causing yields to skyrocket, putting a lot of downside pressure on our markets. We do have some data coming out tomorrow, as well as a speech from Fed Jerome Powell that will also be very important coming tomorrow morning. We are going to go ahead and get straight into it. If you are not ready, well, you better get ready and get ready quickly. If you are an investor in Tesla stock, hit that like button so everyone knows just how many other like-minded Tesla investors have already watched this video, as well as subscribe to the channel if you guys want to stay up to date with future videos, hopefully help you stay informed and make more money. So we are going to start this video with the reason exactly why Tesla stock is down. At the time of recording this video, 3.23%. It's from Deutsche Bank, Emmanuel Rosner, which cut his Tesla stock price target to $285 a share from $300 per share. He did indeed reiterate his buy rating, so he did not lower his rating, but he lowered the price target. There's one thing in particular that is causing the stock to sell down over 3%. It is what he had to say about 2024 that markets don't like. It says, quote, the larger risk we see is downside to expectations for 2024 on both growth and earnings, Rosner wrote in a note to clients. And that's because Tesla indicated at Deutsche investor meetings that it's no longer planning to expand output at its Austin, Texas, and Berlin factories to 10,000 vehicles per week. As a result, Rosner said he believes Tesla will forecast 2024 deliveries of approximately 2.1 million vehicles, which is well below the current FactSet consensus of 2.3 million vehicles. So let me just break this down a little bit further. Elon has said for many years now, multiple years now, Tesla will grow deliveries at 50%. Compounded average over time. That means some years could be 45%, some years could be 55%, but you're going to average around 50%. Now, 2.3 million vehicles, which is the market's current analyst consensus estimate for 2024. Well, if Tesla delivers 1.8 million vehicles, in which that's what markets are expecting for this year, and we get 2.3 million deliveries for next year. That is implied growth of about 22% for next year, far below 50%. What about 2.1 million vehicles, though? Well, that growth is going to be far lower. Divide by 2.1 million. That would be 15% delivery growth next year. Almost 14% delivery growth next year. That is far off 50%, and Tesla shouldn't deserve the multiple that it has if it only delivers 15% growth next year. So that's the dilemma here. Markets are like, hey, do we believe Rosner and Deutsche, or is it going to be even higher than 2.3 million? Is Elon on the next earnings call, or maybe the Q4 earnings call, going to calibrate people's expectations? What if he says expect 30% compound delivery growth rates? Well, that totally changes the valuation proposition for Tesla. Even at 2.3 million vehicles, that's pretty recessionary-like estimates, let alone 2.1 million deliveries for 2024. Deutsche Bank says, however, there is a bright side. With the company not trying to push as much volume, there could potentially be less pricing pressure next year, wrote this analyst. And let me just be honest with you guys. 15% delivery growth, 22% delivery growth, those numbers are BS. They're not true. If they are true, The economy is in a very deep recession because this would be the slowest growth in Tesla's publicly traded history. You would never have ever seen that. So are you willing to make that bet? Are you willing to go against what Elon has previously guided for year in and year out and has hit those targets? I'm not willing to, but it is having a material effect on Tesla stock today, dropping the stock over 3%. And this news comes at a really bad time. The market's not exactly in a great place to be able to handle 15% delivery growth next year for a stock that trades at 70 plus times earnings. This is just outright a lie in my personal opinion. This really doesn't make sense, and I don't think Elon reiterates this on the earnings call. I don't think Elon goes from saying 50% compound delivery growth rates to 15% next year. Is that really what Deutsche is trying to push here? Makes you question Deutsche as a whole. And what's interesting about this fall we are seeing in Tesla stock today, the option activity is actually quite bullish. You have seen 681 orders totaling $453.44 million with a positive order value of 70%. After Deutsche says we're going to get 15% delivery growth next year. 70% of option activity is bullish on $453.5 million worth. That's kind of strange. Let's get into all of the Tesla stock news that you need to know as a Tesla stock investor today. First and foremost, take a look at this video right here. Isn't this incredible? This is the video of Optimus that we just got, right? From 2023. Look at 2022. The thing couldn't even stand on its own. They were tinkering with it. It just wouldn't work. I mean, look at it now. That is a lot of progress in a very, very short amount of time. Kia has announced that its new 3-row EV9 electric SUV will start at $55,000 when it goes on sale in the US later this year. Up to a 300-mile range, it seats 7 with a 5,000-pound towing capacity and 800-volt DC fast charging. The $55,000 version gets 223 miles of range. Thoughts on the starting price? Ask Sawyer Merritt. Seems reasonable. Here is some news that I talked about in the video last night, but auto suppliers urge Biden to provide financial assistance to address the strike. And what they go on to say is, quote, immediate concern for smaller suppliers with revenue of less than $200 million. It urged the Biden administration to establish a small business administration program or other agencies to maintain workforce and operational capacity. So even when the strike is officially over, you could have a lot of problems in the supply chain of autos, and this could be a situation that takes multiple months after the strike is over with to get fully worked out. It's one of those situations where if the strike ends and they can now start working again, well, they don't have transmissions, they don't have powertrains, they don't have, power steering components, they don't have, different parts where they're not going to be able to actually be operational after the strike does stop. So more than anything, this is having a very negative impact on local economies like mine, such as Michigan. I mean, there's a lot of UAW workers, a lot of auto industry here in Michigan. You can already see the dramatic effects of the slowdown here in my state of Michigan due to these strikes and people getting laid off. Tesla brings its extended warranty program to Canada. This is for the Model S, the Model 3, Model X, and Model Y. The new extended warranty program was first launched in the US in March, but it now has expanded north of the border. And it is the Extended Service Agreement, ESA, takes effect after your basic vehicle limited warranty expires 4 years or 800 or 80,000 miles and covers you for 2 years or 40,000 miles. Once the ESA kicks in, it won't cover basic maintenance items like brake pads replacement and other wear and tear items, but will cover the repair or replacement to correct defect in the materials or workmanship of most parts manufactured or supplied by Tesla during the coverage period. So basically just an extended warranty. If your brakes go out, your tires need fixed or something like that, you're not going to be covered. But if your electrical system goes out, if your powertrain stops working, or your battery shorts out and is a dud, well, it will cover those kind of things. Also, some news that was reported last night: Volkswagen to temporarily cut production of 2 EV models due to weaker demand. This shutdown will be from October 2nd through the 13th at Volkswagen Zwickau plant, the spokesperson said. Germany's DPA news agency first reported the news. This comes after Volkswagen said earlier this month it would not extend the fixed-term contracts of 269 employees at this factory. The German automaker is facing rising competition from Tesla and a growing array of Chinese automakers, as well as dampened demand in the European EV market due to high inflation and cuts to subsidies. Adam Jonas with Morgan Stanley and his $400 price target just came out with a new piece on the UAW strike and Tesla. Now, you guys can read this whole thing for yourselves, but I want to focus on the road ahead. What he says right here. It says the UAW strike may last a long time, or it could be resolved any day. We don't know. In any case, each of the D3 must decide what size and character of the auto company it wants to be. Do they really want to be the next Tesla? Is that a realistic goal? Do they want to focus on ICE and 150,000K niche EVs? Can they provide a reasonable on-ramp to their Chinese partners into Western markets? Quote, parentheses, yes, even in the US? We see scope for the UAW standoff to bring to light more consequential, existential issues facing the future of the auto manufacturing in the US. And the role of today's players, legacy doesn't have to be history. Wow. Okay. He's basically saying they will not be able to compete with Tesla, and they might not make it. Or they will be in their specific niches, right? Like a GM might have one vehicle that does really well. A Ford might have one vehicle that does really well. But they don't branch out to continue to be this company or these companies that sell vehicles, a lot of them. That's quite worrying for any of the UAW workers. Quite bullish for Tesla. It looks like Tesla extends the 3-month FSD trial for hardware for owners. Tesla owners who purchased their hardware 4.0 equipment or equipped Model S, Model X, or Model Y with a referral code are seeing the free trial of FSD beta extended beyond the initial 3-month trial period. This, I think, is great on Tesla's part because you could just give a longer trial. More people are going to ultimately convert and buy full self-driving. Mercedes-Benz Drive Pilot to make a US debut in late 2023, priced at $2,500. Mercedes-Benz is set to beat Tesla to become the first automaker to bring Level 3 certified cars to the US. This goes on to say, EQS customers and S-Class customers of Mercedes-Benz in the US will soon be able to add Drive Pilot to their luxury saloon's extravagant options list. The German automaker is bringing its Level 3 drive assistance capability to the US by the end of 2023, ahead of all of its rivals, including Tesla, and the brand has just released additional pricing and availability details. Mercedes-Benz introduced the system in Germany last year, and it now confirmed that California and Nevada will be next, where a limited fleet of EQS models will be equipped with Drive Pilot in late 2023. More deliveries of Drive Pilot equipped S-Class and EQS sedans will start in early 2024. Drive Pilot starting price is $2,500 for the first year, and further pricing and options will be available at a later date. The Mercedes-Benz system is a step ahead of Tesla's Autopilot in the Society of Automotive Engineers certification. Autopilot is a Level 2 system, while Full Self-Driving Beta is Level 2 Plus. And let's be honest here. This service from Mercedes-Benz software is not better than Full Self-Driving. Tesla just doesn't want to take the steps to get Full Self-Driving licensed even higher or ranked even higher, because then you take on a lot of the liability for thousands of people driving FSD, 500,000 people driving FSD all over the roads. It's very hazardous for Tesla's business if you start to get a bunch of crashes and getting sued here and here and here. So that's the situation. Tesla's FSD is better than anyone else's software, but it's a lower ranking because Tesla doesn't want to take on that liability just yet. Ford's decision to hit the brakes on a planned $3.5 billion battery plant in Michigan highlights a challenge for Tesla's growing crowd of rivals in the US market. Tesla is pushing most of them into an unprofitable low-volume niche, according to Reuters. On a brand-by-brand basis, Tesla outsold its next 19 competitors by 10-1 or more during the first half, according to S&P Global Mobility data. Take a look at that. Ugh, that is not good. Not good at all for your legacy automakers. Chevrolet did sell about 35,000 vehicles last year, or half of this year, I should say, but it's nowhere close to Tesla's number. Tesla's 10 times higher than that. Ford, yeah, is not even close as well. The Lee County Sheriff's Department has announced a Tesla pilot program. There are now 20 Model Ys and Model 3s in LCSO's fleet, and the department said the program will maximize cost savings of 50% or more per vehicle annually. And the Short Bear reposted this from Helen Meisler. He has 213.5 thousand followers here on X, and he posted this: trending Great Depression. Yeah, that is not good to be trending. And he actually writes a daily column for realmoney.com on the markets, worked at Cohen, Goldman Sachs, Cargill, former Asian expat, exporter in Shanghai, tennis fan, love to cook. So that is the person that actually posted this. So I will go out on a limb and say it's probably not photoshopped or anything, but I mean, hopefully it is, because Great Depression, nobody wants that. And if that's trending, yeah, we might have an even bigger problem on our hands. The price of oil today is definitely having a negative impact on the broader markets as well. Remember this oil spike, this thing that I've talked about many times, where every recession that you have ever seen has happened right after a spike in oil? Well, oil is continuing to spike. Now it's at almost $94 a barrel. You were just at, back in June, about $68, $69 per barrel. So you have spiked about 40% now. Oil is up 3.36% on the day. And this is not good for the consumer. And again, for the odds of a recession. You also have 10-year Treasury yields, which are up 6 basis points on the day today, and 2-year Treasury yields, which are up almost 6 basis points on the day as well. With a specific focus on the 10-year Treasuries, if you take a look at the last 5 years, the Treasuries are soaring. This actually means the bond prices are falling. So the problem that started SVB and started the banking crisis that we seen in March, when all those banks went bankrupt that everyone seemed to forget about by now, well, it was because yields rose and the dollar amount, the actual value of bonds, has fallen so much. If you take a look at TLT, you could see what I mean. This was back during the COVID times, right? Rona crash over here. Bonds were 150, 160. All these banks were loading up on bonds here in this range. And now, they're $88.35. So the banking crisis, although we haven't heard any news recently on it, if yields continue to rise and bond prices continue to fall, you could start to see more banking fears come into this market. As you can see, the KRE, the regional banking ETF, is starting to make its way back down. It's coming down to test a key level at about 39, and as you can see, the low was down here. So you're off the low, but you're still at the same levels you were at upon the first initial couple of banks going bankrupt. Another big story of the day today is the dollar. The dollar is up 0.5%, and take a look at this increase you have seen since July. This is also putting a lot of downside pressure on markets, and look at this just blow off top kind of move that you are getting over the past 3 days at a time when the markets are selling down as well. Market's selling down, dollar is rising. Now, why is this negative? Well, if you're a Tesla, if you're an Apple, if you are a just Joe Schmo, doesn't even matter. If you're a U.S. based company and you report your earnings in U.S. dollars, but you take in foreign currency, convert that into a stronger dollar, you get less dollars. You get to recognize less dollars for your company earnings. It brings down valuations, brings down earnings, the higher the dollar does go. Well, you're starting to rise again. You're breaking out past, which was an important level at 106. So you're in no man's land. The dollar could rise even more, could put more downside pressure on our markets. Durable goods orders actually came in a little bit better than expectations at 0.2% month over month. Keep in mind there's a lot of revisions here, so who knows what the number is going to look like over the next couple of months. The number could be way negative. You never know. You were expecting negative 1.4%. So durable goods not as bad as what they could have been, but the big data is going to be coming tomorrow is your first round. GDP growth rate quarter over quarter. The final estimates for Q2. Initial jobless claims. Corporate profits. Fed Goolsbee at 9 a.m. And the big one is Fed Jerome Powell at 4 p.m. If he changes his statement, if he has anything hawkish to say or really just doesn't change anything and continues to be hawkish, I think the markets are not going to take that too favorably. And then on Friday, you have the big data. That is personal spending, personal income, core PCE price index month over month, and year over year. And I would like to point out again, this is the chart from 1987 and Black Monday. This is the chart now, and you're looking very, very similar to that. I mean, you're basically looking the identical, right? You literally look identical. If you go ahead and pull up the S&P 500, it's getting worse, guys. It's not getting better. We're not showing signs of a bottom. You're falling every day. You're closing towards the lows every day. It's not showing any sign of slowing down. Your next stop is the 200-day moving average on the S&P 500. That is at roughly $415 per share. That's when you can actually see your first bounce, in my opinion. And then markets can reconsolidate from there and see just which direction they want to take this sucker. But, yeah, I mean, it's just not looking great. If you look at Tesla, for an example as well, Tesla just broke under its 100-day moving average. Tesla had been showing a lot of support, a lot of strength above that 100-day moving average. Now you're below that. Your 200-day moving average is down here at about $205 per share. Whereas, I mean, if you look at the S&P 500, Tesla is holding up much better than the broader markets as a whole. But if you start to get more expectations of 15 to 20% delivery growth next year, Tesla will not hold up well. Ultimately, that's your buying opportunity because Tesla's delivery numbers are going to be way better than that. You and I know that, but Deutsche Bank is. I'm conflicted with this one. I really am conflicted with this one. Saying 22% delivery growth, that's one thing, but 15%, they're both wrong. But 15%, are you lying to markets? Are you just that bad at your job that you don't understand what Tesla's numbers are going to do? I mean, it doesn't take a genius to figure out it's going to be better than 15% next year. So I'm really conflicted with that one. Let me know down below in the comment section what you guys think about this information. Specifically 15% delivery growth. 2.1 million deliveries next year. We're expecting 1.8 million this year. That would be the slowest percentage of growth for Tesla's business ever. Ever. You've never seen 15% delivery growth at Tesla, ever. I'm not willing to make that bet, especially since the Cybertruck comes out. But a little bit more on the technicals. Again, guys, the stock's turning down. This false narrative is being spread with Tesla. Next stop is 205. You're going to find some support around 220, and then 210, 215, your $5, $10 increments are going to hold a little bit more weight and a little bit more importance. But if you break under all of those levels, your next stop is your 200-day moving average. If you look at the MACD is starting to go negative. That is not a great sign. If you look at the RSI, that is curling down. You are now at about 39. That is also not a great sign. So if we do get negative news tomorrow, as far as economic data. If Jerome Powell does spook the markets even further, if the data on Friday is bad, you're going to your 200-day moving average. And be prepared for that. If markets get even worse and we do go through a really kind of negative period and you do get 3 to 4% down moves, which is possible, then it gets even worse. Then you could go under $200 per share. We will elaborate on this more in the next video that comes out at 9 p.m. tonight. That's going to do it for this one. That is all of the news you need to know, all of the analysis you need to know. Number one thing that I ask you to do is let me know what you guys think about this note out from Deutsche Bank today. Are they onto something? Are they just outright lying to markets? 15% delivery growth seems... I mean, I'm just going to shut my mouth there. I'm going to get in trouble with the YouTube algorithm if I continue on. So that's going to do it for this video. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day. If you guys want to come trade with us live in real time, link down below in the description of this video. We are hedging out our portfolios. We're going long. We're making some YOLOs. Check it out. If you guys want to be a part of it, come sign up. If it's not your cup of tea, then you can, not be a part of it. That's always an option as well. Support the channel. That's going to do it for this video. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.